Hey guys, welcome back to another video. Today we're going to be talking about the 5 common mistakes that I see business owners make when they're trying to sell their business and hire representation, a business broker. And so just as a background, myself, my firm up in Canada, Robley Capital, we are brokers of businesses. So we're focused on the lower mid-market space with businesses worth anywhere from $1 million in value up to about $50 million in value. And so I've seen a lot of these mistakes just simply through my own day-to-day business where we have clients that come and want to engage us because they've tried to sell their business in the past with someone else and it hasn't worked out. So let's just jump right into it. So the business broker landscape is highly fragmented. And I was just pulling up some research, and I was even surprised at how many business brokerage firms are in the United States. Just in the U.S. alone, there's about 4,000 business brokerages, and those, there could be multiple employees within each of those brokerage firms. And so the industry is growing because there is demand for this type of service as the baby boomers are looking to retire and transition a wave of companies in the next 10 years. But, the top 3 firms hold less than 5% of the market share of that $1 billion business broker market in the United States. So there's a lot of options out there. There's no real big standardized firms like, when you go to the banking sector, they're the big banks. And so you can feel comfortable going to those bigger names because the service is consistent and it's going to be done right. Whereas here, you're going to be dealing with a lot of solo entrepreneurs and single shingle type business brokers, maybe some smaller boutique firms, but it's much less defined. And so it can be confusing when you're looking to decide who do I really hire to represent my business. And, when you look at the statistics, it's amazing to see that, in most instances, over 50% of the businesses that you see for sale listed online don't actually go and sell. They're listed, but, something happens or the offer falls through or there's, no real targeted marketing effort to get that business sold. So when you're picking your representation, you're not only hiring someone to manage that process to reduce the burden on you as the business owner, but you're increasing the chances, if you hire right, to increase the chances of actually selling your business. So for our team, we have probably a 90% success rate in terms of selling our mandates because we're very focused on what we take on. We manage everyone's expectations accordingly, and we're highly professional and have a standardized process. Now, that success rate is very high relative to other firms. So the difference is really the quality of that firm. So let's jump into the mistakes. So mistake number 1, and I see this all the time, is not getting a business valuation or value guidance from the broker upfront prior to signing an engagement letter and committing to one shop. So you may have an idea of what your business is worth, but it's really important that when you go to market and you start interviewing business brokers, instead of throwing out your number, sit back and ask them to provide a business valuation or at least a market value range to see how they think through valuation. And oftentimes what ends up happening is if you give your number and that broker really wants your business, even though they may think your business is worth a different number, what are they going to say? There are certain brokers that may say, I disagree. I don't think it's that, and they part ways. But there are other brokers that are simply looking to sign up clients. And so sometimes they're not really interested in the success rate as much as signing them up front, having a stable of mandates, looking busy, and getting the monthly fees that come with managing all these files. So it's really important that before you give your guidance, you really want to get a sense of how they think about your market value. And maybe they can even put together very brief, and this is what we do in our business. We'll meet with a seller, we'll ask for their financial information, and then we'll put together a rough financial model and give them a value range and some drivers and limiters and explaining here are the pluses, here are the minuses, here are the things that buyers are going to really like, and here are the things that buyers aren't going to like, and have a really good open discussion. And I find that, it is tough to have those discussions up front because sometimes you got to get feedback that you don't want to hear, but it's also really important because if you're not aligned on valuation right now, what ends up happening is that you go to market, the market thinks differently than what you think the business is worth, and you're in for a surprise. And either you don't sell, you get fatigued, you get annoyed with the broker, you get annoyed with the buyers, and you have just a terrible time going through that process. Versus if you know up front what the market thinks about your value, either you can say, I'm going to hold off for a year, correct, and grow the business to get to the value that I want, or you need to adjust your expectations, which oftentimes happens, especially when you need to sell, you're close to retirement. Now, the same thing applies on the real estate side. So, say for example, you have a business and you own the underlying real estate. When before you go to market, it's really important to get a valuation done up front, because what that does is it locks in at least a decent value range on the property, but the value of that property also influences the value of the business. Because if you're paying rent to your real estate company, what rental rate are you paying? Because right now, when you own it, you can decide what rental rate you want to pay because you're the landlord. But if you were to sell that business and then that real estate is sold to a separate buyer, you need to set a market value rental rate between the business and the real estate that you own. Because oftentimes the buyers don't want to buy both. There are different sets of buyers. There's business buyers and real estate buyers. Not all the time, but I would say quite frequently we sell the business only and then address the real estate sale separately. So even though you may think it's a completely separate mandate, maybe you don't even want to sell the real estate. What you should do is at least get a preliminary valuation done on the real estate, because it's still very relevant for the business valuation. And if you have any sort of environmental concerns, get those done up front. Get those reports, environmental reports, the building condition reports. Invest the time up front so that you know and can manage your own expectations, and so that the broker that you're hiring is aware of these deal parameters. Because certain brokers, they move fast, they want to get to market quickly, but you never really have that honest discussion and that feedback loop where you can honestly say, is this even a sellable business based on my current expectations? And honestly, not a lot of people like to have those conversations. So that's the most common mistake I see. Now, mistake number 2 is choosing the wrong M&A advisor. So, again, the business broker landscape is so fragmented and there are so many options out there. So it's really important when you're hiring and looking to interview firms, you need to kind of ask the 3 key questions. The first is, what is your target market? In terms of the size of the business that you're selling. Do you sell only $1 million businesses, $10 million businesses, $100,000 businesses? What's that average size or that range of clients that you work with? What industries do you work with? If I'm a technology company and you only sell retail hairdressing businesses, well, then you're probably not best equipped to manage that file for me. And so the ideal situation is that you're right within their sweet spot. You're not a very big file for the firm. So if you're working with a very small business broker and you're a $10 million firm, you don't want to be their largest client, because they'll have very little experience in dealing with you, and the style of selling that business is very different than a small business. And then vice versa. Sometimes you may have an accounting relationship with a big, firm like a KPMG or an Ernst & Young, but you're a very small file relative to the other M&A files that you work on. Don't force that relationship and try to be the smallest file at a big brand name, because even though they have a nice big brand name, it's not profitable to work on that account from the M&A broker's perspective, because you're considered a small file. So what ends up happening is you get pawned off to the junior M&A guys at those shops who maybe don't have the experience or just simply are not going to push as aggressively. So you want to be right in the middle, not too big, not too small, just in their sweet spot, because then that's what they do on a daily basis. Their incentives are aligned with you. They're not going to feel lazy pushing your file, because that's the type of work that they're doing. Now, the second question is, what is your marketing approach? And this is really important. Certain brokers have certain styles. The way I kind of call our firm is we're very rifled. We kind of reach out to maybe 30, 40, 50 buyers, but we're very rifled in terms of who we reach out to. There are other firms that are more online-based firms that are going to canvass an email list of 20,000 potential buyers, and they'll blast out that opportunity to 20,000 people. Now, which one are you more comfortable with? Which one is going to work better for your business? Is confidentiality a major concern? Well, if it is, then probably that email or blast or aggressive marketing approach is not going to work. So before you commit to a broker, it's really important to ask what their marketing approach is, because each approach is going to differ and relative to the type of business that you're in. And then as well, it's really important to understand the business broker landscape. And so I actually kind of put together this little table here to explain to you really kind of the different brokers that exist in the pool right now. And so here on this axis, you'll see that it's the transaction size. And then here's the level of service or the quality of service, but it's all really relative. But in general, you'll see at the top right, the size is very high, the level of service is very high. Those are the banks and the large M&A firms. If you're working with a Goldman Sachs, an RBC, a TD, those firms, they're going to give you a very good service, but also they have minimums. They're only going to work with $50 million plus value type companies. So if you're $1 million HVAC contractor, you're simply just not going to get the attention, and they're not going to serve you. So what ends up happening is you can go down a level. And so, the accounting firms, the KPMGs, the MMPs, the Ernst & Youngs, the BDOs of the world, these types of accounting firms, they have a more broader range in terms of the types of sizes of deals, but their level of service is not as boutique or as specialized. They're much more of a wholesale solution relative to the more boutique firms, versus you could go with a boutique firm, but they probably are not going to serve you in terms of the size of the transaction. But really, for most business owners that are going to be watching this video, they're probably more focused on the bottom end here. And what you'll see is that, as the transaction size gets lower, the quality and the service of the available firms also declines very proportionally. So on the far left, bottom left, you'll see the online M&A firms, buybiz.com, different types of email marketing type business for sale websites, which, provide a purpose for retail type businesses. But if you're more specialized, or you're sizable enough that you can warrant working with a business broker or a boutique firm, choosing an M&A firm like this may take on unnecessary risk around confidentiality, or not really meeting the quality standards that you need to get a deal done. There are real estate brokers that are coming into this space. Now I have my issues with them because they're not really full-time in this space, and the level of service is probably not as good. You have the single shingle kind of guys, the solo brokers, or the one or two guys that partner together and just sell businesses in their local state or province. And so they're perfectly fine, but just understand that they're going to be smaller sized type deals, and probably the level of service and the extent and the depth of their bench strength is very limited. And then you go all the way to the right, which is, there are, for certain size businesses, I would say there's $1 million cutoff here, where $1 million and above, like in our firms, like I would put our firm right over here in this area, where we're a very small size boutique firm, but we work with $1 million plus type transactions. And so we offer a very good service, but we can't do that for a $100,000 value business. So what you end up happening is there is a service gap here, unfortunately, between lower mid-market firms and small businesses. So just based on this landscape, you kind of want to pick and choose, because everything's, I would say, the level of service, it equates also to the level of cost. So the more you go to the boutique firms, the larger banks, the more fees you're going to pay, the higher that potential fee is going to be relative to an M&A firm or a business broker that's doing this on the side. So do you want to work with that level of service and pay a little bit more? Or do you want to work with maybe just a more wholesale solution, a cheaper option? So that's really the business broker landscape. So keep that in mind. And so this also is a segue into our third mistake, which is not working with M&A professionals who are dedicated full-time to facilitating M&A transactions. And so I can think of a few examples. Maybe your accountant says, "Hey, listen, I'll sell your business. We have other clients that are in your sector that will look at this. Let me broker it myself. I'll send a few emails." Or you got that buddy that works in banking that's like, "You know what? I could sell this business. Yeah, let me help you. I know how to do this. I do this in my job for different things, but I could do this just on the side." Or maybe it's your lawyer, or maybe it's your real estate agent that says, "You know what? It's similar to selling a house. I'll get involved and we can start selling this business for you." But I say this and I highlight it right here. Unlike wedding photography, M&A is not a part-time gig. It's a lot of work to close a business. I would say on average it takes 9 to 12 months. And the process of maintaining contact with potential buyers, maintaining contact with the potential lenders that are going to finance that deal, you need to be in that market and plugged into that market. So the quality of part-time support relative to the full-time guys that are in the space, there's a big gap there. And so I oftentimes, hear of that one accountant that took on that file, ran it by 15 potential buyers. It didn't work out, and then they came to us, and then we ran a structured process, reached out to 80 groups, targeted, built the research and the decks and everything, and got the business sold. But it's not the accountant's fault in terms of their ability, and they're smart. They're pretty smart. It's not that. It's just that they don't have the time to really represent you and push that file forward. And so it's really important to find someone that does this full time. Don't go with the part-time solution, because traditionally they're cheaper, but as well the quality and the success rate is what you're really worried about. And so that's this section, the second section over here, which is, when you're looking at the part-time solutions, the thing that you're playing with is the probability of closing. Because, with full-time solutions, they're going to be pushing more, they're going to have more resources to invest in marketing your business versus the part-time guys. And so ultimately, you want to increase your chances of selling, because the longer you're in market, the more probability that a competitor finds out, or an employee finds out through word of mouth, or the market changes and all of a sudden your valuation changes. You don't want to play around with that. Like, if you're in market 18, 24 months and there's no action on your business, the risk is now things can change. And so what you originally went to market with a set value, that value may change either to the positive sometimes, but also to the negative. So you don't want to play around with that. You're in market, you move quick, you get the deal done. If you stay in it too long, you can risk a lot around your valuation, your exit value. So that's why when you're hiring full time, at least you increase your chances of moving quickly through that process rather than, someone that's not going to represent your best interests. Now, mistake number 4 is choosing the cheapest M&A option. And you can kind of see these mistakes all revolve around the same things. Someone that's not dedicated full time, someone that's cheap, or someone that's just not, pricing their time correctly, or working with someone that, again, like the wrong type of broker. So the mistakes are all relevant, but they each highlight important things to consider. So with mistake number 4, when you think about pricing that work, it's really important to understand that even though you may pay a little bit more with a more professional full-time solution, ultimately the probability of closing increases if you hire better representation. And so that's really important, because if you hire a part-time solution and they're cheaper, but they don't get that deal closed, ultimately you paid whatever you paid for and the deal never closed anyways. So you just paid those fees for nothing. Versus if you pay a little bit more, you structure the deal to make sure that it's incentivized on closing, where they have a success fee that's sizable and that they're going to get rewarded, that broker, on the back end when they actually close the deal. Well, then, the risk of you paying that only happens when the deal actually closes, versus you paying unnecessary fees to market the business, and then all of a sudden it actually never even closes, and then you're out of pocket with those fees. So when you think about the options and the different types of pricing structures, if a broker's asking for hourly fees, milestone payments, and ultimately they're asking for a lot of upfront that's not contingent on the deal closing, then I would be weary. I would be really concerned, because I would say at least more than 20% of that total fee, if they're asking for it up front or at LOI or upon month 3 or month 6 or whatever the case is, the question is, well, why should I pay that milestone fee? Because at the end of the day, if that deal does fall through at the last minute, I'm out of pocket, a lot of upfront fees. Now, the flip side also is relevant. You don't want to be working with brokers that are 100% contingent on success fees, where they have no money up front in it, because there's no skin in the game. Think about it. If I take on a mandate and I know that the probability of this closing is going to be very, very kind of 50-50, even from the broker's perspective, I'm going to invest more time in the deals and more resources in the deals where I actually can recoup some of the cost up front. So, in our firm, we have a retainer. We have a monthly, retainer, and as well as an upfront fee. But I would say that upfront and retainer fee maybe equates to 10% of the total fee that we would get on a successful closing, because 90% is structured on the back end, but that 10% at least covers our cost, and we can put time into it. We can have an analyst put together the package, the financial model, get the marketing materials in place, and start pushing that mandate. So if you go and a broker is like, no, just give me the financials and I'll start marketing that business. My concern there is that, okay, that's great because it's cheap and there's no real risk of you losing some money if the deal doesn't close. But is the goal not to put money out, or is the goal to actually just sell? So there's a balancing act there. That's what I really want to caution you towards. And then the last thing I'll say, this third point over here, don't be afraid to negotiate those fees. Sometimes what ends up happening is that the compensation structure is just plain wrong. They have maybe there's 10% fee up front and then 90% is back end loaded, but the fee is just a flat percentage for any deal value. Well, what may be interesting is you kind of lower the fee for the first $2 million, and then you increase the success fee for the remaining, for anything above that threshold, so that it incentivizes the broker to bring higher offers and spend more time marketing and putting time into that deal, because they're going to get paid more if they bring you a bigger deal and a bigger exit value. So there's different ways to structure it, but again, compensation on the back end, I would say 10% upfront, 90% back end, or 20% upfront, 80% back end. And that way you're at least aligned, versus hourly fees or no contingent payments, or someone where, I've heard these crazy situations where, accountants are like, yeah, I'll help you market this business. Yeah, just pay me $375 an hour and we'll see what comes out in the marketplace. Like, it doesn't matter to the accountant. There's no risk. Sure, they just charge you. Nothing comes out of it, and then you walk away and you're just out of pocket for really the wrong compensation structure. Now, mistake number 5, and the last one that I want to talk about, is working with a broker that rushes to market or that skips that front end preparation phase of the M&A process. And I would say this is probably the most recent for me personally, because we just came out of a mandate right now where we were working with a manufacturing business, got referred into it. They had 2 primed buyers that were talking to them, knocking on the door saying, oh, I want to buy your business. It's perfect and all this. And the seller's all whipped up thinking, here's a preferred buyer. I can get a quick deal done. I just want to bring you guys in, start talking to them, and let's get an offer from them. And so, as I said at the beginning, we sell over 90% of the businesses that we take on because we follow a process. And so the first thing that we said is, that's great. We're going to keep them warm, but we're not going to move that process to the offer stage. We're going to take a step back, take a month to 2 months, and simply build that confidential information memorandum, that CIM, a financial model, organize your information, the employee data, the operational data, fixed asset list, equipment list, whatever the case is, the real estate valuation, get all of that structured, have a clean set of numbers, and then we'll move those buyers forward. And the seller's like, well, no. I mean, I don't want to lose those buyers. And it's like, listen, the challenge with that is that if you run at different wavelengths and you try to push certain sellers forward, you end up in a 1 or 2 seller buyer situation. And so your negotiating leverage is weak. And if those buyers pull out, all of a sudden you still have to do that work anyways, but now you can't pivot, and it ultimately delays you, because now you spent maybe a month or 2 trying to negotiate with these buyers. They ultimately kick the tires, move on, and now you have to go back, build that package, and go back to market and ready that business. Why not do it up front and then go to market and target a broader range of buyers where you have that competitive auction pressure to extract value? And I'll give you another example. So we're selling another distribution business right now, and it's the exact opposite. They came to us and they're like, listen, I want to sell. And they bought into that process. And so we built the package, we built a financial model and everything. And so we went to market. We learned the business, because that's the whole point of this preparation phase, is that as a broker, I'm not going to know that business as well as you do. But ultimately, by going through that process, I at least have some good knowledge to speak to that business, to speak to your customers, what makes you tick, share that story, and sell better, because I've spent the time up front. So when brokers try to skip that process and they say, no, I don't believe in that. I don't believe in Sims. Just give me 3 years of financials and I'm going to start talking to buyers. Well, I mean, you do get to the buyer phase quickly, but the quality of those conversations, the speed at which those buyers can convert on that information and actually put it in an offer, take it to their investors, take it to the bank, get financing, all of that slows down because you don't have package and the information organized. Versus when you have the package, they can take that package, go to their investors, go to the bank, qualify the opportunity, and put it in an offer within 3 to 4 weeks. So yeah, you take the time up front, you learn it, you learn to sell better, and you also then are able to convert interested buyers quicker. And that's the power of taking that first 1 to 2 months when you hire a broker to organize yourself before you're actually starting to talk to buyers. And so just to jump back to that story. So we're selling this distribution business. We go through the process. We take it to market. Boom, we get 13 offers on the business. Super hot. And so interestingly enough, they had a preferred buyer as well. Most sellers that we come into, they have 1 or 2 people that have in the past have suggested that they wanted to buy the business. So we went to that buyer, And interestingly enough, of the 13 offers that we got on the business, they were the lowest one. They were the lowest one. And so here we are thinking, wow, here, if we just went to that one buyer, we probably would have had a lot of problems trying to bump that buyer up to a higher valuation. But here we had a process. And so we picked up the phone and said, hey, listen, this business is perfect for you, but you're lowballing this opportunity right now. You're the bottom, the last offer of 13. What are you going to do about it? And I swear, in the next day, we got a bump of $2.5 million on that business. And they've leaped up to top 3. And that action, the reaction to that, they believed us because simply we were running a process. And naturally, we had the leverage and the power of that auction to incentivize them to say, listen, if I really want to buy this business, I better actually start moving and be more competitive. And so that's why investing that time up front was really good for that seller. So even though you feel that you can do a quick deal, skip that process, I would very much caution you when you're interviewing M&A brokers, spend the time to actually listen to their process and ask, how much time up front are you going to spend learning about my business? What type of detail do you get into? Because if they get into detail, they'll typically find out things that will ready you, because they'll go ask questions. That Q&A portion of that preparation stage is good because they're going to ask you tough questions that you ready yourself and ready your answers. Versus if they grab those financials, go to market, and then put a buyer in front of you, well, all of a sudden the buyer's going to start asking you those questions, and you may not be as ready or prepared and have that supporting information to provide that rebuttal. So that preparation stage, super valuable. And that's why I spent so much time on this mistake. So hopefully you guys liked the video. If you do have any questions, please do reach out to me. You can reach out over LinkedIn, reach out to the Finance Kid email, or you can also comment below. And if you found the video helpful, please do share it with any of your colleagues. And please like and subscribe to the channel for more videos. And if you have any businesses that you're thinking about selling or buying in the Canadian marketplace, please reach out to me. That's what we do on a day-to-day basis, and I'd be happy to help you. So thank you and have a great day.